now is the time for us to introduce Woodie Neiss. Woodie, would you please turn on the microphone? All right. And now.
Here we go. Is that better?
All right. Wonderful. Well,
okay.
pleasure to meet you. I know we plan to have a chat at some point before, but you know, good to see you here. I'll let you take it away now.
Okay.
Wonderful.
Don't go anywhere yet because I want to make sure that I can share the
Okay.
slides that I have. So
yeah,
don't leave me.
I am here.
Okay.
You can click Alt S.
Okay. I think it looks like. All right. Okay. I did it. This is amazing.
I can leave you now.
Okay, you leave. Yeah. All right. Okay, guys, it is phenomenal to be here. I've been listening to some of the presentations today. It's quite frankly exciting to be a part of this. Because of this amazing event that CfPA has put together. Kudos to you, Peter, Samson, Brian, even Scott, for the work that you've put into putting this event together. I love the fact that it's taking place online where we can all do this virtually. So kudos. Also, it is just really, really cool to be here with many of my peers who, quite frankly, are the ones that have built this industry. You know, we had our hands in creating the framework for it and pushing it through. I'll talk about that in a second, but it's all these other players that have come to the table that have really made it what it is. And I love it. So, you know, it's just been great. I'm gonna focus on data and the impact that it's had. I'm gonna try and fit all of this in about 15 minutes and leave the rest for Q&A. But first, let me jump into how did we get here with a little bit of a timeline that you've heard before. So I'm just gonna run through it really quickly. I got involved in 2010. I created the startup exemption framework with two of my friends, Jason Best and Zach Cassidy-Dorian. It was meant to be another exemption from the securities registration. We brought that to Washington, D.C. We lobbied Congress. I went actually through to my May 2011 testimony because I wanted to see, you know, did I talk about economic impact as it relates to this? And it was interesting because my hypothesis at the time was the following: by revamping the Securities and Exchange Commission's position on solicitation and accreditation, we can open the doors to small business growth and prosperity, allowing for an exemption for crowdfund investing, which includes protections for investors, will spur innovation among your constituents, create jobs, increase customer spending, and reinvigorate our economy. So that was the hypothesis. Now I'm going to get into the facts, which is that it's done exactly that. So in 2012, we did have the passage of the Jobs Act. It was like one of the highlights of my life, as well as Jason and Zach's, to be invited to the White House by President Obama for that bill signing ceremony and the work that we did on it. As we all know, the industry didn't launch until 2016. At that time, we did launch the first industry data aggregator. We called it CClear, for clean, collect, and sort of analyze and report on everything that's happening in the industry. And so for 5 years, we've been collecting all of this data on all these offerings. With that data, most recently in 2020, we launched we did the integration with Bloomberg, I think, which is a huge thing because it takes all the data and what's happening in the industry and it brings it over to one of the largest financial services firms to do more detailed analysis and reporting on what's happening in the industry. And that's going to be picking up more in the future as we expand our relationship with Bloomberg. This year, we launched the Online Investment Index, which we're super excited about because we wanted to figure out a way in which we could translate what's happening in the industry, particularly with this economic impact that's happening, into a visual that makes sense for users. And so the index tracks the daily top 50 regulation crowdfunding offerings. If you've been following us, you see that the index is actually at this hockey stick type of curve right now, and I'm going to be talking about that. It's really exciting to translate that into our YouTube channel called The Crowd, which launched just about a month ago, and is getting great feedback. And I just really talked about what's happening in the industry, the top 5 things, and let people ask questions. So let's jump right into the economic impact that we're seeing. First, I'm going to talk about total capital. Now, you give data to any data scientist, they will slice and dice it any which way they want. You will get two different figures. So I'm just going to put that out there as a caveat, that I look at the information that is taking place in regulation crowdfunding from RegCF offerings, or equity crowdfunding, but I call it RegCF, parallel offerings as well. So if they're doing a side-by-side offering with a RegCF offering and let's say a 506C offering, I include all that information in the amounts as well. So if it's a RegA offering, I'm not including that in what I'm going to be talking about right here. If it's a 506C, which is an online investment accredited offering, I'm not going to be talking about that either. I just really want to hit on, when we went to Washington, D.C. 10 years ago, and we were talking about the potential of this, what is the potential of that exact framework equity crowdfunding today? So we've got $793 million in capital that's been invested, that's been committed to all the campaigns. Now, if you look at campaigns that have closed and been funded, well, that amount switches to 770 million. So 97% of all the capital that's been committed to these campaigns to date has been invested. So it's turned from escrow into investments and handed over to the business. Now, if we look at campaigns that have not closed yet, so these are offerings that are still active and live, and just to put a little a number behind that, there's about 700 active offerings on a daily basis right now. A year ago, that was about 300. But those open offerings that are funded, so they've already hit their minimum funding targets, about 18.5 million sitting in escrow that will go to those companies, and 4.3 million that is sitting there. Those campaigns haven't hit their funding target yet, so it's possible that that money could go back to investors. Now, the key thing about this $770 million that's been invested is there's been about 1 million investments that we've captured in the past 5 years. So the average investment to date's been about $770. I love to point this data point out because I think it talks to the logic that's built into the system. Investors want to get into these offerings. They want to help out startups and small businesses, mainly in local communities and local entrepreneurs that they have a relationship, in businesses that they understand. But we're talking about a lot of retail American investors. We're also talking about accredited investors as well that have deeper pockets. But the reality is these investors are deploying what I believe is a very rational amount of capital. $770 should not represent an individual's entire savings or their investments. So it's great to see that there's some logic in people diversifying into this marketplace, but not risking more than they can afford to lose. And I think that's really important to point out, because when we were pushing this legislation and talking about it in Washington, D.C., people were often talking about, grandma losing her savings. Well, the reality is, grandma probably can't figure out how to get to these platforms or figure out how to invest. But if she did, she's not going to lose all her savings. So next, let's jump into the total number of companies. To date, we've captured about 3,500 issuers. So these are individual companies that have gone on to raise money via equity crowdfunding on over, I think there's been over 70 platforms now. Some of them have closed. So you can see a broad selection of platforms, a lot of companies coming in. There are 561 companies that have done multiple offerings. So the total number of offerings that we have in our data set is much greater than the number of issuers. It's almost 4,100 to date. So what's interesting about this is we're seeing the number of issuers coming in jump dramatically. It's almost a double from last fiscal year to this fiscal year in terms of the number of issuers coming in. We think that's going to increase easily over the next 12 months as well. But another interesting thing within the issuers as well is when people were talking about, what kind of companies are coming into this space, we were thinking it would be mainly your retail small businesses, type of entities. Well, the converse is actually true. What we're seeing now is a lot of larger companies coming in that are more established. That means they've got revenue. That means they have more than 3 years of operations under their belt. The reason that I want to point that out is because those are the type of entities that could traditionally go into a bank and say, listen, I want to borrow money from you. And they're going to say, I need 3 years of financials and you have to complete this form. Well, many startups and small businesses might not have 3 years of operating history. So it's fascinating to see that companies that are more established are skipping banks or skipping other alternative traditional means of financing and coming to the crowd for that capital. If we go to this next slide here, we can see that there's been about 1,166 cities across the nation that have been that have had an offering. I think that is one of the coolest things about equity crowdfunding. You know, when you think about financing startups and small businesses, everyone immediately thinks about Silicon Valley. They think about Boston, you know, MIT. They think about New York City. These are hubs that have deep pockets and a lot of individuals. So the ability to see issuers all across the country, in all states in the nation, being able to raise capital successfully from many investors that are local in their communities, I think speaks volumes to the fact that this model is working. And our government and other people should be spending more time figuring out how to help facilitate an understanding of what's happening in the marketplace. Because if I've been listening to what other speakers have been saying, I think one of the things that's holding this industry back is the fact that we don't have more eyes, ears, and you know, awareness on the industry. So while capital major intensive areas like Silicon Valley are your traditional things, you don't have to be in Silicon Valley anymore to raise money. And I think that speaks volumes when you look at that map there and you can see how Utah, Colorado, even, you know, Idaho, and all across the South, you know, you've got companies that have been very successful in these cities that are raising capital. If we jump to the next slide here, by the way, I'll point out you've got Hawaii and Puerto Rico that have quite a bit of traction as well. So I wanted to break down the industries as well so you could see the broad application of equity crowdfunding across many different industries. Again, I think there was the misperception that software publishers were going to be the biggest beneficiaries. Well, you know, if you look at that data right there, you'll see that they are the #1 beneficiary across all industries. But then it gets really fascinating. If you look at the rest of them, well, first we've got 472 different industries represented. We capture Neiss code for each company when they file. So to see that there's such a broad distribution of industries across this speaks volumes to the fact that investors have a very strong sentiment to invest in these type of offerings, and they don't necessarily have to have a PhD in it to understand the type of investment or the company itself. We've got restaurants that are the second highest beneficiaries of this. So who suffered the most during COVID? Restaurants did, okay? They all shut down. So the fact that during COVID, and that's when we saw the spike take off in regulation crowdfunding, we've got so many more investors coming in and helping support local restaurants, I think speaks volumes to, again, why this model works and why we should spend more time focusing on it. You know, you do have your internet commerce, you've got your distilleries and breweries. I skipped over that actually. This, I think, speaks volumes to the fact that you have a craft beer and you've got a group of local people that love your beer. They're going to become investors because they want to see you grow and scale. It's, you know, it's just been obvious. The same holds true for distilleries. I'll also point out that breweries and distilleries probably aren't the easiest thing to fund either from a bank perspective or a VC perspective. So for these industries to have access to capital and a group of investors that believe in them and want to back them, I think is amazing as well. I pointed out the restaurants in there. Internet and e-commerce is another obvious industry that would receive a lot of capital. I think the last one, though, that's the 5th most funded, is motion picture. So again, what we're learning from regulation crowdfunding is where you have an engaged group of investors, customers, fans, followers, you can turn them into investors for your business. And if a motion picture has, you know, a bunch of people that love it, guess what? They're going to become marketing advocates for that motion picture, which means more people are going to be coming in. Now, what's interesting about this slide and the information that you're seeing right here is if I add up the top 5 here and what that adds up to, it's about $152.9 million of capital that's been invested into these industries. That represents about 20% of the total invested dollars. Now, you might looking at this and those are the top 5s, that's obvious. But what I want to point out to you is 80% of the rest of the capital is spread out among 460 something other industries. And I think, again, that speaks to investor sentiment. It speaks to the broad appeal for regulation crowdfunding or equity crowdfunding across any different industry. And you don't have to think that you're not going to raise any money if you're a company in, you know, there's this one Boxable right now that's Unfoldable Homes. I mean, that seems like the type of business that, you know, more sophisticated VCs or all would fund, but they're raising millions of dollars right now. I think they're over 2,000 backers too. So it's been fascinating to see, you know, every day I look at this and I'm like, wow, that's a cool company in an industry I never thought would have gotten funded. Okay, so if we jump now over to jobs, I think now we start to talk about the more of the economic impact that we're having in terms of job creation. So we estimate that there's about 120,000 jobs that have been supported by companies that have been successful with the regulation crowdfunding offering. If you look at the offering documents itself, that's about 14,900 that have been disclosed. But that doesn't reflect your indirect employees, your seasonal employees, people that help support a business but are not your FTE equivalents, your full-time employee equivalents. We estimate that there's over 104,000 of those that help support these small businesses. And why is that important? Well, companies pay payroll taxes on every employee that they hire. Employees, of course, pay payroll taxes, so all this goes into the government's coffers. All these salaries that are being supported pay for income taxes, they pay for rents and mortgages, car payments, leases, food, clothing, the list goes on and on. That is all economic stimulus that's happening because these companies have been successful at raising money from the crowd. Based on interviews we've done, issuers are hiring on average about 2.7 people within 90 days of a successful raise. So I think that speaks volumes to the ability of this to create new jobs. And that's just a vital economic stimulus at a local level. Again, these are all local businesses that are raising money from local investors. All this money is being pumped back into local economies to the tune of about 1.6 billion dollars. I moved too fast. So we analyze the financial statements of all of the issuers that come on board, and we estimate that there's been about at least $1.6 billion that has been pumped in local economies. So that's used, again, if you're looking from a company's perspective, to pay for everything from payroll, cost of goods sold, rent, insurance, utilities, marketing. Many of these expenses are paid to local service providers. So Amy Cortez, who wrote the book Local Investing, says that if you look at the money that's pumped into a local economy, it usually circulates 6 times before it leaves. So if you take that 1.6 billion and multiply that by 6, that's about $9.6 billion that's been invested into local economies. Okay, this is another way that governments cannot get their hands down to the most micro level of these economies because they're focused on such a high level that they can't get deep down. Focusing on equity crowdfunding and helps them support these businesses by default, and what I'm showing you with the data shows that this money will stimulate all these local economies. The other thing I want to point out here is about 40% of the issuers that come through regulation crowdfunding are women, minorities, and people of color. Again, if you compare that to Silicon Valley, it's a gross difference. I mean, I think it's about 2% of companies that have women or minority founders get funded. So the fact that women and minorities and people of color can come here and successfully raise money from, again, people that know them, I think is a great avenue and it's proving valuable. I know I'm running out of time, so I'm going to try and speed up here. I only have a couple more slides and I am done. This one I think is another perfect reason why we should be doing everything to support this. The market value of firms that have been successful with the regulation crowdfunding offering is $29 billion. So we look at all the offerings. Not everyone's doing an equity offering. So if it's a debt offering, they're not disclosing a valuation per se. But we set up. You can see that there's been $24 billion of market value to date. And this brings up this case study that I want to point out. Distilled is a company that did an offering on regulation crowdfunding. They've also done Reg C, a 506C offering, and a RegA offering. They did their first offering on RegCF in June 2018. They raised $65,000 from only 99 investors at the time at 52 cents per share. Well, they just filed for an IPO with a projected share price of around $5. So if you were one of those early investors in Distilled, you would have had an 861% return on investment in 3 years. These are the opportunities that we're going to be seeing and hearing more of coming up. The last 2 things that I want to point out is, like I told you, we started this online investment index. You can see if you look over to the right-hand side here, This is 2020. This is when we were hit with COVID. Right here, we saw a drop off, but from there, things just started picking up. This spike right here is when the SEC changed the caps from 1 million up to 5 million. So there's a lot more interest in this industry because now you can complete a full Series A offering online, which used to be the domain really of the VCs. But it's fascinating to see that we're at this tipping point and we're starting to scale. So I'll just wrap up with a few thoughts here, and then I'll jump over to Q&A. I know I'm really at my time, but bear with me. We estimate that over the next 12 months, there's probably going to be about $1.2 billion additional, $1.2 billion invested. That's just because there's more awareness coming into the space. We're at this tipping point. You've got larger issuers coming into the market. And they're not here necessarily for the capital that the crowd's providing, but for the marketing awareness that they can get from the crowd that's going out there telling other people the businesses that they invested, this cool company that just started, and it helps spread awareness and increase it. Like I said, issuers can do a Series A online. VCs are starting to syndicate deals into this marketplace, which I think, again, proves the validity of this. The fact that VCs see the opportunity within the equity crowdfunding market says that they can provide the capital, the crowd can provide other things that they can't, be it the Rolodex, marketing, or what else. Then I'm just going to tell you that I think the next big thing to come in are IPOs. We're going to be seeing more and more of these IPOs. That's when the media is really going to cover what's happening in the industry. And the other thing that I think was touched upon a little bit during the presentations is the next big thing that I think we're going to be hearing a lot about is secondary trading and investor liquidity. This regulation crowdfunding requires a 12-month holding period on these securities. So once they're seasoned, there is the potential for them to be trading on alternative trading systems. And I think we're going to be hearing a ton more about that. So with that, and with me speaking 5,000 miles per hour, I'm going to tell you that you can get in touch with me at Sherwood@theccagroup.com or follow me on Twitter at Woodie. Again, we've got that YouTube channel called The Crowd that we started out of the Online Investment Index. We've got a newsletter that comes out frequently. So you got data questions, we've got data answers. Peter.
Woodie, thank you very much. This was amazing and wonderful to have you on. One of the founders of the industry in the United States. Thank you for giving it to us. Now, we don't really have a hard cutoff. Maureen, let's give Woodie just a couple of more minutes to answer some questions we have accumulated here in Q&A. And if you want to cover some, I guess, some aspects of the presentation that you hadn't before, I think it will be okay. We rushed the conversation up until this point, but now that we're in the final stages.
Oh, okay. Let's just relax and I'll have a chat now. You can ask me any questions that you want. So this is a great opportunity, I think.
Great. Well, Maureen, I hope you don't mind. I hope you don't have a hard cutoff as well. So, I mean, we have, one of our questions yeah?
I was saying, no, I don't mind. I'm going to drop off the stage now.
Okay. All right. So one of the questions I'm seeing here coming from Samson is, what is the ratio of accredited investors versus retail investors?
Yeah, that's a good question. So one of the things that we purposely stay away from is personal identifying information. We don't want to be regulated in any way because we're really a reporting company. So we try not to dig into knowing anything about the investors themselves. But what I will tell you is we constantly are interviewing issuers and we're asking them questions like that, what % are retail versus accredited? I would say that the 80-20 rule is what I hear more often than not. 80% of the crowd that's in a lot of these deals are your accredited type of investors. But I'm also hearing that 80% of the capital comes from that 20% of accredited investors that have deeper pockets. So you've got a lot of small time, little average Joes coming into the space, but you've got your bigger ones coming in, and I would generally say it's about the 80-20 rule.
Wow, the 80-20 rule just working out just like that, huh?
I mean, I wasn't planning on it, but that's what I'm hearing.
Cool. And one of the questions I'm seeing from Trevor Hunt is, what is the greatest risk to the continuing success of the crowdfunding industry?
That's a good question, Trevor. I mean, I think it's the same systemic risks that you have in any sort of financial services industry. If there's fraud, it's going to have a ripple effect because the media is just going to focus on that. There's been zero fraud, and I actually forgot to point that out, according to an SEC report that came out in this industry to date. So, I think that poses a risk if something were to happen. Quite frankly, I think it's nearly impossible for someone to commit fraud in the space because you've got to spend a time, money, and effort putting one of these offerings together to commit fraud. And I just think there's much easier ways to do it than this route. But that being said, the other things that I think are a challenge to the industry are market awareness. If we don't get more of the financial services sector taking what's happening in this industry seriously and understanding the potential of it, particularly with the numbers that I just pointed out, I don't know if we're going to see the true potential of it. Now, that being said, I think the data is showing us, particularly from what happened, with post SEC changes, that we are at a tipping point. So, I'm not that worried about, things not happening. I think it's just going to take a matter of time.
We did reach out to the North American Venture Capital Association to see if they wanted to join in, but I think it might have been a little last minute. So it would be very interesting to see how they see it.
Well,
yeah.
I think that's a great point. Like if you've been looking at the deals like we do, you're starting to see, where VCs are syndicating these deals alongside the crowd. So not all VCs are there yet. In the beginning, and I don't know, most people don't know this, but the way in which we came up with that $1 million cap is when we were socializing this idea for equity crowdfunding in Silicon Valley, because we took the framework there before we went to Washington. We said, at what point would we be stepping on your shoes? And they said, we said, is 1 million fine? They said 1 million is fine. We don't have no issue with that. We said 5 million? And they said, then you're starting to play in our space.
I mean, 5 million is up to Series A, right? That's
exactly. Yeah. So this creates a great opportunity for the VCs that see the opportunity within equity crowdfunding. Because what is a crowd? Listen, I started a business. I did 3 rounds of financing. The 2 questions that I always got are, who else is in, and tell me about your customer base. Okay, if your customer base are your investors. That proves that you've got people that are so interested in your business, they're willing to put their money where their mouth is. I don't know any other proof of validation that necessarily is stronger than that, other than your revenues, of course. I'm not, that a strong team. But if you can prove that people are willing to part with their dollars to become investors in your business, to then go out and do marketing for your business, I think I'd want to invest in that as a VC as well.
Yeah. We're speaking, I've had a couple of conversations with folks about how do you structure a marketing campaign for equity crowdfunding raise. And the way that kind of we're thinking about it is it needs to be kind of, integrating social media, integrating kind of a buying process for folks. First, experience the product, and maybe potentially investment kind of drip on people for a long time. And I think VCs will come to recognize that.
Right.
Well, Woody, I hope that you stick around after Maureen's presentation. I think it's we could bring Maureen up. Thank you very much. This was very interesting.
Thanks, everyone.
All right.